Today I'd like to discuss Chapter 4, Income Statement and Related Information. So in this chapter, we'll be looking at the income statement, usefulness, some limitations, and then talk a little bit about quality of earnings, the format, reporting various items that are somewhat unusual, and then other reporting issues such as accounting issues. We'll also look at the retained earnings statement, and we'll end up talking about comprehensive income. So the income statement is useful, right? It evaluates past performance for a period of time, usually 1 year. It can predict future performance, right? You see 5 years of income that's increasing, that sort of thing. And then it can also help assess any risks or uncertainties of achieving future cash flows. If you look at some of the information close, and probably not just the income statement, but you may want to take that information along with maybe the statement of cash flows and some of the disclosures in the income statement. Some limitations, companies omit items that really cannot be measured reliably and are sort of required to only, as we saw the concept statements, right, that we have to have representational faithfulness. So we can only really include items that are measured somewhat reliably. Income can be affected by the accounting methods employed if you use straight line versus accelerated depreciation or LIFO versus FIFO. So we do have different accounting methods for different assets, which can cause some I wouldn't say inconsistency, but it might, for comparability purposes, might be difficult. Quality of earnings. So you want, of course, the information or the expectations of GAAP that Wall Street expects the information to be close to perfect. We do know, and you've probably seen this in other classes, that companies tend to manage income. Sometimes call it income smoothing, and they do it within the rules of GAAP. An example would be that I could reduce some of my discretionary expenses short term, say, and companies do this, advertising or research and development or maintenance. I reduce those expenses short term, it's going to increase my income. But of course, long term, the effect might be negative, or probably will be negative. Elements of the income statement. So we have revenues, and including revenues, probably the main one would be sales. It refers to sale of product, fees like consulting fees, interest income, dividend income, and rent income. But of course, sales will probably be your main source of income for a company that sells product. Some examples of expenses, of course, cost of goods sold. If you're selling a product, the cost of that product would be an expense. Other expenses include depreciation, interest, rent, salaries, taxes, so forth. All right, gains and losses are also included in the income statement. These are from peripheral or incidental transactions. I think we saw a little bit of this maybe in the first few chapters. But for instance, if you sell your equipment, right, gain of a sale of equipment, that would be a peripheral transaction. It's not part of your normal course of business, so it wouldn't be included, in your gross profit, but it would be included on your income statement. You normally would, particularly if it's material, would show those types of sales separately. The same thing with loss. A loss of, if you sell an asset but at a loss, we would show that not as part of our gross profit, but as part of the, or not from income from operations, but we would show it separately as other loss or other income. All right, format of the income statement. So we refer to most income statements use what we call a multi-step income statement approach. I'll show you that in a second. We separate operating transactions from non-operating. So the operating would be your normal course of business and selling your product. Non-operating would be what I just mentioned in the previous slide, the sale of a truck or sale of equipment and so forth. We match costs, the cost of goods sold, with revenues, and then we highlight components, certain components of income that analysts might use in assessing financial performance. So one example is that you might have earnings per share, or you will have earnings per share on your income statement. All right, intermediate components. So companies, common for companies to present some or all of the following within the income statement. So we have an operating section, which would be the sell of our normal product. Non-operating would be sale of equipment or other assets. And income taxes and discontinued operations would be if I were to sell or sell off or discontinue a segment of my business. Normally, it's going to be a loss. When you have discontinued operations, you might be able to get someone to sell it or buy it from you at a low price, but in a lot of cases, we're just abandoning that section of business. Then a non-controlling interest is if we own a small amount, maybe 5%, 10% of another company. When you do own interest in another company, you need to use either what's called the cost method or the equity method. We would show those amounts on the income statement. And finally, as I mentioned a minute ago, that earnings per share will also be shown on the face of your income statement. So here's the multi-step income statement. So of course, we start with sales revenue, less cost of goods sold, because gross profit. Then we have our operating expenses. So everything above here, right, income from operations is our cash inflows and outflows from sale of our product or service. We may have other revenues like dividend revenues and rent revenue. Again, we could have a gain, say from a sale of fixed assets. And other expenses and losses, we had some interest on bonds and notes, interest expense on bonds and notes. All right, and then we deduct that and we get our income before income taxes, subtract income taxes, and then our net income. And then on the bottom of the statement, we see that our earnings per common share. On the corporate report, typically the income statements can be very condensed. So if you look at a corporate report, they're not going to give you all this information. We're going to give you this much information. You'll have one line of sales, one line of cost of goods sold, and so forth. You may have to have some disclosures related to that information. If you're publicly held company, you're going to have those disclosures in order to be in congruence with GAAP. This is a single step income statement. So this would be for a company that just really basically has revenues and expenses. All right, reporting various income items. So 4 kind of unusual and frequent items that we need to account for on the income statement. None of them a big deal. Unusual gains and losses. So that would be, like an extraordinary gain or loss. A discontinued operation would be another type of loss. A non-controlling interest, which is something that we had to measure using. So it's an investment we have in another company, and we'd have to measure it using the cost method or equity method. And then earnings per share. So unusual and infrequent gains or losses has to have kind of two characteristics. It has to be unusual, so high degree of abnormality, clearly unrelated to the business, the ordinary typical activities of the business, and then very infrequent, so it may only occur every 5 years. So if we have some kind of traumatic event, that there was a tornado that took out one of our plants, wasn't fully insured, that would probably be, was in Tornado Alley, not in Tornado Alley, probably be an unusual and definitely infrequent occurrence. Here's some common types of unusual occurrences. So a write-down of receivables, impairment. So the receivables, a good portion of those, we're not going to be able to collect them. Might be because of the economy. A write-down of inventories. So a high percentage is obsolete. A write-down of plant and equipment, goodwill, and so forth. A restructuring charge. So that means that we might restructure. Maybe we have a new bonds. We're restructuring our bonds, maybe a higher interest rate because we're maybe a higher risk. So that would be an infrequent loss, or there could be a gain from that if we structure it with a smaller interest rate. Gains or losses from sale or abandonment of property, plant, and equipment. We just abandoned some equipment, couldn't sell it. Effects of a strike. Gains and losses if we extinguish our debt obligations. We'll talk about this one. Casualty losses, and then gains or losses on sales of securities. So this is just showing you the number. That's 500 large companies. I don't know. It sounds like Fortune 500, but it's not saying it's Fortune 500. But apparently there were 202 restructuring charges and 209 write-downs, gain losses, or 289 write-downs, gain and losses, and asset sales. And this is in I believe, a 1 year period. So I don't have the footnote on where this came from, this information. Discontinued operations. So companies eliminating the results of operations of a component of the business, might be a segment or a product line or a geographic division. And then number two is that it represents a strategic shift. So it'll have a major effect on companies' operations results. We'll show that net of tax. So the tax part will be the taxes that affect that transaction will be shown separately from all the other taxes that we need to pay. Here's an example of a discontinued operation. Kansas City Products, highly diversified company, decides to discontinue its electronic division. During the year, they lost $300,000 net of tax. They sold the division at the end of the year at a loss of $500,000. Show how the discontinued operations will be reported. So we had income. Normal income was $20 million. So now below that, we're going to show the loss of operations, which is $300,000, and then the loss on disposal, which is $500,000. But I suppose it's kind of analogous to having a timeshare that you don't want to keep losing, right, $300,000 every year. So it's probably best to bite the bullet and take the $500,000 loss. But we would show that below the income from continuing operations because it's not normal course of business. It's separate from our normal course of business. Intra-period tax allocations, tax within a period, can help us understand the impact of taxes on various components of income. This would be an example, by the way, the taxes on discontinued operations of intra-period tax allocation. So it's used for these two, income from continuing operations and discontinued operations. So we're showing intra-period allocations, so we're showing income tax of $184 for operations, and down here we're just showing these net of tax. So the taxes have already affected the transaction. So these numbers here, this 36,000 is net of tax, meaning that it's not related to the taxes up here, and we're not showing the tax. We're just showing that the amount net of tax are loss on disposal net of tax. We do show the taxes here out of 24,800 and 41,000, so you do show them if you wanted to see the amounts. But this is called the 54, the 90, and the 36. We're saying those are net of tax, that we don't include the tax. So we've taken out the tax already when showing these numbers. All right. So this is an example of a discontinued operation with a gain. Schindler has income before taxes of $250, had a gain of $100 from discontinued operation. Assuming a 30% tax rate, Schindler presents following information. So they actually showed a gain of $70,000 from selling off that discontinued operation. And this would be an example of a loss, that we had a loss of $100,000 from discontinued operations. We can reduce that by taxes, right? We get a deduction, in other words, for the loss. So the loss is really only $70,000. The amount that affects our bottom line is $70,000. So if a company owns substantial interest, greater than 50% in another company, they require consolidated financial statements. That we're not going to cover in here. You'll cover that, I think, in Accounting 504. But if we do have, say, less than 50%, that's a non-controlling interest, and it's not attributable to the parent company. So we would just show it using what's called the equity method, or if it's 30% or higher, it's equity method, and then cost method if it's 10 to 30%. So Coke has 70% of outstanding stock. Coca-Cola bought 70% of the outstanding stock of Coke. Because Coke owns more than 50% of Coke, it consolidates their financial results with its own. So GAAP requires that it can be allocated to the controlling and non-controlling interest. So basically what we're doing here is we're going to consolidate Coca-Cola results with Coke company results, leading to a 71.24 consolidated net income. All right, now there was, in this case, it was a controlling interest, and that's why we use consolidated statements. Reporting various income statement items with earnings per share. It's just basically income divided by shares. We'll use weighted average shares. Sometimes we'll have what's called preferred dividends, which is kind of like a bond. And if we have preferred dividends, we will take those out when we're required to take those out when computing earnings per share to give the user a better fit. Because if you have preferred dividends, you may have to pay those to your bondholders. All right, let's move on here. So that's an indicator. That's something that some investor would be interested in the earnings per share. It must be disclosed on the face of your income statement. I'll show you how that works a few slides up. All right, so EPS, if I had $350,000 income, got some preferred dividends, pay these shareholders. And again, it's like a bond, so you're kind of required to pay these dividends. And that's why FASB wants you to reduce your income by that amount when computing EPS. And then we'll divide by 100,000, which is our weighted average of common shares outstanding. And then we get to show that on the face of the income statement. So you can show the amount per share of common stock, the amount related to continuing operations, and the amount related to disposal of the discontinued operations, as well as the income from discontinued operations. Accounting changes is another reporting issue related to the income statement. So we have a change in accounting principle. So we don't really, the FASB is okay with this, but I don't like it. And we talked about in this little box here, these changes result in lost consistency from period to period. This also demonstrate through the numbers that the newly adopted principle is preferable to the old one. In other words, it more fairly presents the financial information of your organization. Here are some examples of changes in accounting principles. Retrospective, there are some examples on here. FIFO to average cost, LIFO to weighted average, FIFO to LIFO, percentage and completion method for construction to completed contract method. And then probably maybe the most common one would be changes in depreciation methods, change from straight line to an accelerated method. So we will show the cumulative effect, the cumulative effect of this change, and that we'll have to adjust beginning retained earnings for that. So it's as if a thing had been in place all along, because now we're going to readjust our retained earnings for that effect in accounting principles if it's material. All right, so here's an example of a change in accounting principles. We had Gaubert Company decided in March 2017 to change from FIFO to weighted average. Their income before taxes using the new weighted average method in 2017 is $30,000. Okay, so let's take a look at this. So in 2015, they used FIFO, and 2016. In 2017, they're changing to FIFO. This shows a change in accounting principles for those 2 years, for 2015 and 2016, that excess of FIFO inventory over weighted average method is $8,000. Then we'll also show the income amounts based on the change. All right, so we're changing to, even though we're changing to 2017, notice that we show, and this is disclosed in the notes, it's not on the face of the income statement, but notice we show, hey, if we did weighted average method, income would be 35, not, what was it before? Weighted average method was 40, so it would be 35,000 in 2015 instead of 40. So we show the amounts now for weighted average, but previously these would have been FIFO, right, have been 40,000 and 35,000. But now they're 30,000 and 27,000, and I guess 35,000 back in 2015. All right, so we show this we disclose this in the notes of the financials, but we need to show what the effect would have been on income if we use this method all along, and then we adjust the retained earnings as of the beginning of, in this case, 2017. Change in accounting estimates. These are a little easier. They're not handled retrospectively, so we don't go back and rechange all the numbers. We don't do anything with beginning retained earnings. So that's accounted for in the period of change and future periods. It's not considered an error. So an example might be useful life of your asset. You thought it was going to be a 7-year asset, but it looks like it's going to be a 15-year asset. So that's a good thing, and then we'll have to readjust, though, our depreciation in the years going forward. We don't do anything with the previous year. So if years 1 through 7, depreciation was 10,000, that's fine. So you use 70,000. There's 30,000 left, and we'll do that for the next 8 years. Do depreciation of 30,000 divided by 8 for the next 8 years. All right, so here's an example. So Arcadia High School purchased some equipment for $510,000, which is estimated to have a 10-year life with a salvage value of $10,000 at the end of that time. So depreciation recorded for 7 years on a straight line basis, right? So 500,000 divided by 10, so it looks like they're taking $5,000, 50,000 a year. So for the first 7 years, they took 50,000. In year 8, it's determined that the total estimated life should be 15 years with a salvage value of $5,000 at the end of that time. Have to let the dog out, sorry. When a dog wants to go out, right? Okay, so anyways, in year 8, it's determined that the estimated life is 15 years instead of 10 years, and salvage value is still, salvage value is just 5,000. So now we can take the new depreciation amount, because I'll show you this in a minute, but you'll have a new depreciation amount based on the book value that's left over and the salvage value, the new salvage value. All right, so as I mentioned earlier, we took $50,000 of depreciation for the first 7 years, so we took $350,000. Fixed asset has a value of $510,000. Cumulative depreciation is $350,000. So the book value now, right, is $150,000. Follow me here. We paid $510,000 for the asset. I've taken $350,000 in depreciation. Book value, just so you're aware, is equipment less cumulative depreciation. So the new net book value is $160,000. And we're going to use that to determine the new depreciation. We have salvage of $5,000, so we're going to depreciate $155,000 divided by 8. So the only problem now is we had a really nice round number before, but now it's $19,375 is the amount debited to depreciation expense and cumulative depreciation for, I guess, the next 8 years. Don't do anything to the first 7 years. That's going to stay in the books. We don't do anything to retained earnings. So the change in estimate is an easier calculation than the change in accounting principle. Accounting errors, these happen sometimes, even with computerized systems, or maybe a mathematical mistake, an oversight, someone forgot to. Sometimes companies forget to record some of their adjusting entries. I don't know if that's on purpose or not. Suppose if they just recorded accrued revenues but didn't record any accrued expenses, that might be suspicious. Mistakes in applying accounting principles, maybe a mistake in applying LIFO that you use, maybe some of the wrong layers, need to redo it. So the accounting error, though, will hit your retained earnings, that you will have to adjust your retained earnings for the effect of that accounting error. So Hillsborough determined that incorrectly overstated AR and sales by $100,000, so that's going to reduce retained earnings by $100,000. So it's just a summary of the 3: change in principles, change in estimates, and correction of error. So the correction of error, we call that a prior period adjustment, is all you need to do is on the prior period adjustment, you would need to make an entry and restate or reduce your retained earnings by the amount of the error. All right, so just a summary. Change in accounting principle, change from one GAAP method to another, FIFO to weighted average. So you do need to recast prior year's income on the same basis as a newly adopted principle. So your previous years, you'll have to restate your income amounts for the previous years, and you have to show that on the, well, I mean, it was, say, 10 years, you would show, 8 years of it probably in the notes, and then the new amounts, though, for you normally would show 2 years this year and last year, so you would want to show, last year's income statement with the restated amounts. Change in estimates, like a change in depreciation method. So we just move forward on that. There's no changes to retained earnings and no changes to previous income amounts. If you have a correction of error, you're going to have to restate prior year's income and then also make an adjustment to retained earnings. All right, retained earnings, we know increase by income. Could change in accounting principle, could increase retained earnings on prior period adjustment. An error, for instance, that went our way, an error but increased income, so it would increase retained earnings. Decrease by losses, dividends, change in accounting principle if it was lower. I think, if you change from LIFO to FIFO and the effect on income made income lower, could decrease your retained earnings. And then prior period adjustments, for instance, an error in the financials that you'd have to readjust. Now, if the error was just, for this year, then we could just readjust the retained earnings. If the error was of this year, you can do it prospectively. You can do it in this year's financials. But if the error was a previous period, the error was in 2017 or 2016, then we would need to make a prior period adjustment and adjust beginning retained earnings, and then restate those financials that needed to be restated. Here's an example of a retained earnings statement. Beginning retained earnings plus income less dividends is your ending balance. Before issuing the report for the year ended December 2017, you discover a $50,000 error that caused 2016 inventory to be overstated. Overstated inventory cost of goods sold to be lower and net income to be higher in 2016. Will this discovery have any income on the reporting of the statement retained earnings? So remember, the error is a prior period adjustment, so we would need to adjust retained earnings by that $50,000. So now the balance of retained earnings, instead of being $1,050,000, is just $1 million. So it would show up on the retained earnings statement, and then you have to adjust those previous year's income statement amounts as well. Sometimes we might have restrictions on our retained earnings. This will be disclosed in the notes, required to be disclosed in the notes. We call that appropriate retained earnings. So maybe one of our lenders wants us to appropriate $50,000 retained earnings as part of an agreement, for a covenant that we have related to a line of credit that he is allowing us to have. So say, hey, we'll give you a line of credit, but you're not in the best financial shape, so we want to appropriate $50,000 of your retained earnings. That needs to, of course, be shown in your notes to your financials. All right, we've got to have ourselves here. Comprehensive income, we kind of talked about this a little bit. So it's everything in the income statement, and then add to that gains and losses that bypass net income but do affect stockholders' equity. So this is just a normal income statement that unrealized gain or loss on available for sale securities, translation gains and losses on foreign currency transactions, these types of things, and they're specific ones, and they must be reported in stockholders' equity. So we can display it one of two ways: a single continuous statement or two separate but consecutive statements of income and other comprehensive income. In other words, you show your normal income statement along with your comprehensive income statement. So this is the one statement approach. Does not require a second statement. Net income is sort of buried in the subtotal. So, but here we show the comprehensive income as part of the statement of comprehensive. You show that as part of your income statement. And then this is a two-statement approach that we have the normal income statement and then the comprehensive income statement related to, say, foreign currency gain or loss. Comprehensive income will be shown in the statement of stockholders' equity. So following items are disclosed: contributions, issuance of shares, distributions to owners, reconciliation of the carrying amount of each component of stockholders' equity from the beginning to the end of the period, and then changes in equity from the and total equity for the period. So show you that right here is a statement of stockholders' equity. So you show the beginning balance, changes like income. Any comprehensive income must be shown on the stockholders' equity statement, and then unrealized gains or losses. So if they have an unrealized gain due to a foreign currency transaction, we show that on the stockholders' equity section, $30,000. All right, and so that's a statement of stockholders' equity, and then we have the balance sheet presentation. So stockholders' equity will also be part of your balance sheet, and it'll be shown. We don't have to show the beginning balances and ending balances. We just show the amounts. All right, so everything else is IFRS. So I'll let you read through that. I don't really, as you notice on the test, I don't really cover too much of the IFRS because GAAP is really more or less backing away from IFRS. So we're gonna probably show a minimal amount of IFRS in the course. Hey, I appreciate your attention, and I'll see you in Chapter 5.